Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at the SPY, which is our proxy for the S&P 500. We're going to be doing our Elliott Wave analysis first and then looking at some basic technical analysis afterwards. So, first things first, I feel I need to clear the air, put my cards on the table. I've been saying for months that I think the market's going to peak in the summer and then it's going to roll over, and that we're in the fifth of the fifth wave, all the way up the cycle degree. Given recent price data, I no longer believe that's the case. That's it, simple as. I still think the market's going to peak this year. I still think we're in the twilight of the bull market. I still think we're going to see the mother of all crashes, and I think all of that is based on technical information, regarding not talking about fundamentals. Just going on the count and the way I see it, that's what I think's happening. However, I don't think we're there yet, and the reason is recent price data has had me had to go back and rejig the count. And during the exercise of doing that, this is why I've been delayed getting the SPY count out to you for the last week or two. Is I've really spent a lot of time looking into it and looking at it, and I've decided I prefer something else. I could be wrong, but that's what I'm going to present today. So, without further ado, let's get underway. Now, I do believe a correction is on the cards, imminently. I just don't believe it's going to be the top of the market. We are so overbought, it's getting kind of silly. But the overbought condition we've reached, and the way it's come about, and the way it's accelerated, suggests to me that we have entered a wave 3 of some kind, and it is not the wave 3 of the 5th of the 5th. It's the wave 3 of the 3rd of the 5th, and we could have a considerable period of time, months left before this market peaks, maybe even into next year, into 22. So I'm going to show you that, but before I do that, let's just go over what I was talking about before. Now, in the last SPY video, we were talking about the idea of an expanding ending diagonal, like this, where we had 3 into a 1, 3 into a 2, 3 into a 3, 3 into a 4, 3 into a 5. Well, this has been invalidated, and it's what invalidated it made me go back and prompted me to look at it differently. We had the 1, we had the 2, we had the 3 longer than the 1, that's fine in an expanding diagonal, it should be bigger. We had the 4, which was not deeper than the 2, that's when it got invalidated. We have a 5 that's longer than the 3 and the 1, that's fine. But without that extra depth on the 4, this is not an expanding pattern. This is contracting. This is smaller than the 2. The 3 is not smaller than the 1. The 5 is not smaller than the 3. So it's not a contracting ending diagonal. They only come in 2 varieties, and it's neither of them. So we can either carry on bullshitting ourselves that this is some kind of exception to the rule, or we can look at it differently, and I've had to go and look at it differently. Now, I've had a couple of people take issue, say, well, in the futures market, on the ES mini futures, Tom, the 4 is deeper than the 2, so this pattern's still legit. We don't do Elliott Wave on futures markets, we do it on the cash market. And they say, well, is it longer on the SPX? I've checked the SPX, it's even shorter than it here as it is on the SPY. So we're dealing with a cash market here with the SPY, and we were dealing with the SPX, which is a cash market, and this was not confirmed on either of them. So I'm not going to stick with it, so I've deleted it. So I went back and scratched my head and looked at some of the previous ideas I'd had in older charts, and also a video you can find here on my YouTube channel, where I initially suggested a few weeks ago that this was an ending diagonal, but of the contracting variety, like this, and represented the peak of the market. So we've gone 3, 4, back here intermediate, 1, 2, 3, 4 minor wave, 5 minor wave, 5th minor wave, 5th primary wave, 5th cycle wave, market top, started selling off. Once we had what was obviously a 3-wave zigzag, not an impulse, and we bounced, I pointed then to the possibility of this being an expanding pattern, but we didn't come down any deeper. I was expecting to head down to here, and then head up in the 5th. Never happened. So at that point, excuse me, having invalidated this count, I was scratching my head thinking, well, this must be an impulse. And it's like, no, it's not an impulse, Tom. It is a leading diagonal, right? So let's go over and look at the count, the new one. It is a leading diagonal, but it's a leading diagonal into a 1. It's not an ending diagonal into a fifth. It's a leading diagonal into a 1. Let's just zoom in. Which means that this was a 1-2, but this was a 1-2 as well. 1-2, 1-2. That now we're having our acceleration, excuse me, in the free. So we are going to push considerably higher. And when we do finish, it's likely that we're only finishing a third wave, not a fifth. I'll talk you through the larger count in a minute. Now, it could still be a fifth. The other count could still be right, and this could be a 3-4 with a larger than expected 5 into a fifth of a fifth, and then it stops. But the problem with that is the fifth wave has run through in the last week all areas of likely completion given prior intermediate and primary wave degree projections. It's just disrespected all of them. It's been that bullish, that powerful, and it hasn't even stopped to pay lip service to them. So on that premise, the extension we'd be talking about in the primary wave 5 is so out of whack with everything before it. I'm just not buying it. I'm just not buying it. So I think there's a much better alternative to look at. So now that we've established this is a leading diagonal, sorry, the 3 should be back here. Excuse me. This should be 8. Don't know why I've done that. The only way we can get this to be a leading diagonal, we get a slightly higher high in the 3 than the 1, which is what we'd expect. We get an A down, 3 waves into a B, 3 waves into a C, WXY into a 4, per absolute sideways consolidation for a wave 4. We get a 4 which completes slightly below the 3, but pretty much within the bounds of it, and we end up with this sideways movement. And this is what threw me, because, you know, excuse me, got a bit of a cough. You expect to have a impulse wave in the 3, and we had this 1, 2, 3, 4, 5, tiny, just taking us beyond the 1, but it is here. Now you can also count this, depending on how you come and look at this, because we're now dealing with a leading diagonal rather than ending diagonal. You could come into here and still count this as 3. Okay, if you come down to a much smaller time frame and say A, B, C, and this is a 3, 4 into a 5, and then you've got a W, X, Y into a 4 and an A, B, C into the 5th. It's not pretty, you know, but neither was the expanding ending diagonal either. But we can get it to complete. The 5th is shorter than the 3rd wave. The 3rd wave is shorter than the 1st wave, just by a tick. The 4th wave is shorter than the 2nd wave. Everything checks out. Let me just show you what I mean. So if we come up, take the length of our 3rd, move across, project it from our 4, we see that the 5th comes roughly up to the golden ratio, then stops. So 5th shorter than the 3, 3 shorter than the 1, 4 shorter than the 2. It's a perfectly acceptable leading diagonal. So it's not the end, it's the beginning. It's a 1, which means this is a zigzag into a 2, which means we're now off and running in a 3, and I'm not even sure we've got the 1 of the 3 in yet. You know, we're probably going to get a deep correction in the 1, and then we're just going to keep going into a 3 of a 3. So let's come out now and have a look at the bigger count, so I can try and get you across to you the difference we're looking at here. So I still think we're going to get a major top in the summer, and I'll show you why in a minute. And I think it could be a big deep correction, but it won't invalidate this bullish count. So in our alternative count, which got us into a 5th wave, we had, let's just show you it, come out to a daily time frame. We have our primary wave 1 back here, 2 very shallow, 3, 4, this is a flat, this is a zigzag, alternation, and then this huge 5th wave, absolutely bloody huge. Okay, and just stepping up. See? So it could still be right. It could still be right. But it's no longer my primary. This now is my primary, and I think the look is vastly superior. As soon as my chart unfreezes, unfortunately TradingView has been doing this more and more lately. There we go, it's getting on my nerves a bit. So let me show you excuse me, why I like this count. First of all, let's look at the wave relationships. If it wasn't for trading view, moving everything around, there we go. Now all of a sudden, this looks like an impulse wave. It doesn't look like the janky, peculiar wave we've got going on here. Let's just compare the two just for looks. 1, 2, 3, 4, 5. Compared with 1, 2, 3, 4, 5. This I think looks a lot better. The size of this wave degree for our 2 fits. So this is a 1, 2, 1, 2, 1, 2, taking us up into a third wave extension. Right, then we'll get a 4, then we'll get a 5. So much more bullish. Now I'm not saying the other count's wrong, it could still be right, and this could be working our way up into a 5th, but the recent price action doesn't support a major top anytime soon. Even on this scale, it's still a few weeks away. Now fair enough, that would take us out into August, which is still the summer, and that could potentially produce an enormous drop. But we could get the same result over here on this chart. So we get a 1, 2, we're now working on a 3, 4. So if we're projecting 3 coming in sometime soon, we don't know when until we see it, 4, 5, and then this brings us into the 5th of the 3, and this is still in July. I could shift this out into August, right? And we're still in the summer, so let's just do that for the sake of argument. And we move out into August, and then we get a wave 4 at primary degree, the first primary correction we've had since the primary 2 back in September last year. So roughly a year-long third wave at primary degree inside the cycle 5 feels about right. Just as a rough feeling, I'm not saying there's any specific, measurement we should be observing, but let's look at the potential for that wave 4 correction. Let's just hide this channel, it's distracting me. So here's our invalidation point back here at the wave 1. So we'll say primary wave 4, what's the word? Validation. Having one of those moments. Which is all the way back down here. I'm not saying it would get that low, I highly bloody doubt it would get anywhere near this low. 359 spot 33, but it could potentially come all the way down to here and still be a legitimate wave 4 as long as it doesn't invalidate this wave 2. So let's say we made it up to this 3, primary 3, and it was all the way up here. It doesn't have to be, we could stop a lot sooner, I'm just roughly projecting. That would still produce a 20% correction, slightly over 20% correction, which would be big. I don't think you'll be looking at that. Let's look at our targets for a minute. Okay, so intermediate 1 into the 2. Here's 3618. Right, intermediate degree was here, 2618. This was a big extension at the intermediate degree. So let's look at it at primary degree, and it's significantly smaller because we had such a long wave 1. So I'm projecting at 100% of wave 1. Now it doesn't have to, it could be shorter. We could have a shorter wave 3 which would limit how far wave 5 could go. Wave 3 doesn't have to be the longest, it just can't be the shortest. So you could have a wave 3 terminate before 100% the length of wave 1. I've got it at it. But let's say it terminated beforehand, that would then place a limit on the wave 5. But let's just be serious for a minute. The limit on the wave 5 would still be gigantic, because it's the entire length of the 3 minus 0.01% of it. So there's no point really worrying about how much further it could go. We have to see this correction whenever it comes. This month, July, could come soon. I think you're more likely going to see 3, 4 at minor degree come soon, and then you're going to see the intermediate degree come later July or into August, or later, potentially even later into August. And if we project from there our wave 2 retracement, then a 38.2 would bring us back to roughly 406, and a 50% would bring us around to about 390. Okay, and that would be a pretty deep retracement. We've got these 2 peaks here, in the volume. There's a nice one around the 50. It might only come back to the 23.6 and we'd be roughly back in the ballpark of where we are now. But excuse me, it's all about when it comes in. When does this top come in? Alright, now let's look at one more piece of evidence that I really like. Here's how I've decided, and this is something I could not get, I simply could not get on the other chart with the wave 1 all the way back here, or back here even. I could not contain all of this broader price action with this tiny wave 2, and I like, and you know I like it because you see me use it at pitchforks all the time, and they're very strong, very reliable, and they tend to have very good relationships with the price action. Using this as the wave 1, wave 2 pivot, I'm able to contain all current price action. I can still accommodate a deep wave 4 right to the outer bound. Doesn't have to come that deep, could stop on this outer bound, right? But I can still accommodate a deep wave 4 sometime August through September, late July through to late August, and still stay within side market geometry, and still stay above the wave 1 invalidation point. And there's always the possibility that we get an even deeper fall, like I said, and we simply pivot and we take the next pitchfork from the 2 to the 3 to the 4 to find the 5th wave, which might only just have to clear the primary wave 3 in order to be legal. It could even truncate and be shorter. We won't know, we don't know until we see wave 3 and wave 4 complete. So even just coming back to the outer bound here, we'd still be below today's price data if we're going much higher in a 3. So this just contains everything a lot more neatly. Excuse me. Right then, so that's it. That's my view. This is now my preferred count going forward, and this is the count I will be using. I could be dead wrong. Okay, I don't want anyone throwing their toys out the pram with me saying, oh, you said such and such. Look, you gotta go with, I'm a chartist first, and I've got to go with what the technicals tell me, and this count is cleaner and looks nicer, has better proportions and relationships, and just counts more cleanly than our previous count. And so this will be the one I'll be working with now. If price breaks down violently this week, next week, week after, whatever, and I mean violently, as in we can't get a completed impulse off of this leading diagonal, we reverse, take out all lows beneath it, yeah, maybe we've topped, and I can come back and consider an alternative. But unable to make any sense of this recent price action other than as a leading diagonal, I've got to stick with it. So if we've only put in a wave 1, 2, we've got a 3, 4 and 5 to come yet. Alright, before we complete a greater 5th of a 3. It could be the 5th of the 5th like we discussed, but I think we're going higher. We will likely get a short-term correction because we're so overbought. Could be this week, could be tomorrow, Tuesday onwards. We might reverse and start moving down, but I got a feeling that if we do, it's just a wave 1, 2 retracement of this 5th wave of this 5th intermediate wave. Alright, if I'm wrong and it collapses, we can talk. Right then, so let's look at one of the things I wanted to show you of just how strong this move has been. We're just going to zoom in again. I'm going to bring up the indicators now, and we'll hide the count and do some basic technical analysis. But don't go, if you're not into the basic technical analysis, you only have the count. I insist that you stay for a moment because you get to witness a little piece of history here. So first thing we're going to do is bring up our 10, 20, 60 and 250 exponential moving averages, and we're going to bring up our indicators. Our RSI set to a 10 close, green 30 level is oversold, red 70 level is overbought, MACD with a 10 for the short term moving average in blue and a 20 for the long term moving average in orange. Now what you can see, we get a reading here on the RSI like nothing I've ever seen on the hourly time frame before. It's huge. It's up here at 96, 95, 65, 96. So what I'm just going to do is I'm just going to kiss the top of it with a white line, and we're going to see when we last had a reading like this. Such a FOMO kind. I mean, we've simply stopped correcting, guys. Putting it simply, we first stopped correcting at a monthly time frame, then we stopped correcting at a weekly time frame. We've now stopped correcting at a daily time frame. You know, look, red candle inside bar, red candle inside bar. You know, inside bar, red candle, inside bar, red candle. We stopped correcting at weekly, then we stopped correcting at monthly, then weekly. Now we stopped correcting at daily. We're just melting up, right? And we just keep going. So let's get back to that hourly chart for a minute and have a look at this RSI I was talking about. So what we'll do for simplicity is we'll just bring up the RSI itself, and we'll see how far we can go back on the hourly chart. I'm not sure how far we can go back. We'll just keep going. All we're looking for is an orange peak above this white line. Okay, we've stopped, so we can't load any more data. So where are we? 23rd of February 2010. 2010. So 11 years ago. More than 11 years ago. Almost 11 years and 6 months. We have not reached this. So where's here? This is January 2014. We have not reached this level, an hourly degree, until today. Well, not today, until the 2nd of July. Never seen it before. I can't bring up any more data, unfortunately, on the hourly time frame. But as an hourly reading, I think that might be a record for the SPY. It's just crazy. This is a sign of the times. This is a sign of the times. And yeah, you get big readings in wave threes and RSIs. You know, we look for the peak in the RSI to be in the third wave of the third wave, right? Of the third wave. What are we looking at here? We're not looking at cycle wave 3, but we are looking at a primary wave 3, and we suspect that we're in an intermediate wave 5 and a minor wave 3 within a primary wave 3. We're getting some pretty badass a reading I've never seen before on the RSI, on the hourly. So there you go. Let's just hide the count. So that's a little piece of history right there. I mean, if you were watching this live, I was watching this live, and I was like, this thing's just not going. It's only going one way. It's only going one way. We've got that same kind of glitch we had before when we had that insane gap up on bullish momentum. I think, back here in April, we've got that same chart error where we've just got blue. No selling at all, just blue. And an insane RSI reading. Okay, so above our 10, let's come out to the weekly time frame, shall we? And let's start our basic analysis, and then we'll wrap up the video. My voice is going, unfortunately. I've been talking all day. Alright, allergies are doing a lot better now, though. Okay, above the 10, above the 20, above the 60, above the 250, obviously, goes without saying. Has done for months. RSI on the weekly time frame, we have three-way divergence currently, which is not a good sign for the bulls. But I've seen these divergences here, here, and now another one here, and they never amount to anything. 4%, 2.5%, 3%. You know, the market just keeps pushing, and so we had a two-way divergence here, two-way divergence here. If we get a peak soon, tomorrow, Wednesday, Thursday, three-way divergence here, and it will probably just result in a minor fallback before off we go again, because that's all we know how to do. MACD, we've got crossover, bearish momentum, short over long here while the market's pushed higher. Bearish divergence again, essentially between these two highs, high and higher high, high and lower high. But look how strong the price action is. The internals just don't seem to matter. I mean, it was only a week, 2 weeks ago, where more than half, 250 plus stocks in the S&P 500 were below their 50-day moving average, and this thing carried on pushing high regardless. It doesn't matter. You know, we're getting some funky readings. So, yeah, I think we're approaching a top this year. I think we're going to roll over. I still think we're going to peak. I just think we've got more to go. I think the mania. I think the potential to melt up over the coming months, for a few weeks and months, is there. And I think the count supports it. Like I said, I could be wrong. And if I am, I'll be the first to hold my hands up and say, well done, bears. You know, you were right. But for the moment, I just think at least there's no resistance. We just keep going. Right, so that's the weekly time frame. Daily time frame. There's little else to talk about, really. The divergence over the shorter term kind of disappears completely here on the daily time frame. The last divergent high we can find is back in April, and I'd argue that with the high and lower high thrust down to oversold and this tiny correction, that was resetting the RSI, because we've since had a high higher low and higher high into overbought conditions on the RSI here, so there's no divergence between the recent highs like we see on the weekly time frame. We do get it on the MACD here. Always a little bit more telling under these kind of extreme conditions is the momentum indicator here tends to be more telling over these shorter time frames. RSI tends to play out better over the longer time frame when you get these kind of narrow breadth in the market. Like I said, you can have advanced decline issues which don't make sense while the market continues to push higher. It's just the nature of the beast at the moment. Anyway, above all moving averages, overbought conditions on the daily time frame, overbought on the hour like we've never seen before. Obviously some kind of short-term corrections on the cards. Could be the top, but I don't think it is. Right, we'll leave it there. Oh no, one more thing I want to point out is the VIX. Now, this is an argument in favour of the bears for the moment. I'll give them the benefit of the doubt. A lot of people are going around drawing stuff like this. Oh, we're in a wedge, and every time we go into a wedge on the VIX, we we burst out and go higher. Excuse me, I'm losing my voice. We burst out and go higher. Okay, we had one here. You see, the thing is, the size of these things and how long you can hang around in them near the bottom for weeks on end, this doesn't suggest that there's any reason why we should turn around immediately and go flying to new all-time highs. There's freaking loads of room left in this wedge. You know, it's just shit ton of room left. We could come up to here, down to here, up to here, down to here, up to here, down to here, up to here, down to before we even go anywhere. You know, this is out into 2022. This is so drawing wedges on the VIX. You know, fair enough. Yes, they pop eventually, but you predicting when is ridiculous, in my opinion. The argument I would suggest that the bears have in their favour is a far simpler pattern than just trying to find the end of a wedge. We should just get a trend line across all of these crash lows and join them together. There's your case for the bears. That's a much stronger case, I reckon. Here's the taper tantrum, 2018. Here's the you-know-what virus in February 2020. Yeah, here's that meltdown in December 18th. This is the temper tantrum, sorry. This is the meltdown in January of 18. So, I'm a low before the corona. So we can see this trend line has marked the lows, the pivot points of major crashes, and we're right at it again. I'd argue that's a stronger case for the bears to mount their case on than drawing wedges on this chart. I'm not saying the wedges are invalid, I'm just saying you can never predict the end of them. It's just impossible. Alright then, so we'll call it there, guys. I hope you've enjoyed this. If you're new to the channel and you have liked what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Leave us a comment in the comment section below if you want to. And as always, thank you very much to my Patreons. Your support is greatly appreciated. If you're interested in becoming a Patreon, please follow the link in the description below. Have a read of the tiers, see if anything takes your fancy. And if you're not following me on Twitter yet, there's a link also to my Twitter feed in the description box below. Alright guys, take care of yourselves and I will be back with you later in the week. All the best, bye bye.